Everyone talks about how you should follow the 4% rule, that way you can retire wealthy, which says that you need to save up a big enough nest egg. That way once you retire, you can pull out 4% of your assets each and every year. That way you can retire wealthy, but that might not be the best way for you to actually retire wealthy. I'll show you why. According to CNBC, if you follow the 4% rule, you should be able to fund your retirement for 30 years. Let me explain. Over the course of your career, you would work to save and invest your money. That way you can one day have a nest egg, let's say worth $1 million when you retire. Now, when you hit retirement, you should be able to pull out 4% of this, which is $40,000 that you can now use to live off of in year 1 of retirement. Year 2, well, you're not going to have $1 million. Now you're going to pull some money out. Now you're going to have $960,000 here, and you're not going to take 4% of this number. You're going to take this number and pull it out of here, but then factor in inflation, because when the 4% rule was created, it was created back in 1994 by a guy named William Bengen, and back then we had inflation between 2 and 3%. So if you had 2% inflation, that means now you would pull out not $40,000, but now you're going to pull out $40,800. That way you have enough money to continue funding your life as well. But what happens now if you're facing high inflation? Because now let's just say instead of 2% inflation, let's assume that you're facing 6% inflation. That would mean that you'd have to pull out not $40,800. You'd go from pulling out $40,000 to $42,600. That means now each and every year, you're going to be pulling out more and more money, which means your account size is going to be shrinking much faster. If you consistently saw 6% inflation, now this wealth that you built up isn't going to last you 30 years. It's only going to last you 16 years because you're pulling out the money way faster than you originally thought. Now you might be thinking, but Jaspreet, what if instead of just saving this money and having it not grow, you took this money and you kept it invested? And you could do that with the goal of now seeing this money grow as well as you pull out more money, but then you also risk seeing this money get cut in half if you face a market crash. So now what do you do? Is there an alternative? Because there is an alternative that you can consider as well. Now look, just to make sure we're on the same page, I'm not a financial advisor. I'm just a random guy on YouTube. I'm here not to tell you what to do. I'm just going to tell you the things that I see and some things that I do, because I just want you to be more aware. That way you can make more educated decisions for yourself. But of course, if you have questions, make sure you talk to a licensed advisor in your area, and don't blindly trust a random guy on YouTube because, well, investing has risks. I like investing for cash flow, and when you invest for cash flow, you do your investment analysis a little bit differently, because now I start with the end. If my goal is to make $40,000 a year from cash flow from my investments, this is money that my investments are paying me that I don't have to go to work to earn. Now I have to go work backwards to see how much money do I need to invest to actually get this $40,000 a year. And I'll show you how to do this. But if your investments pay you, say, a 3% return, 3% cash flow, not 3% growth in the value of the investments, but 3% of cash flow, which is money I'm getting without having to sell my investments, now I would need to invest $1.3 million to generate this $40,000 a year in cash flow. If I can get a 5% cash on cash return on my money, now I would have to invest $800,000 to generate this $40,000 a year. And if I can get a 7% return on my money, now I'd have to invest $570,000 to get this $40,000 a year in cash flow. Why does this cash flow work? Because now when you see inflation, in theory, you would want to be investing in good assets that are also growing the cash flow. Now, is that always the case? No, but with the right financial education, you can have the right assets, which mean your cash flow will also be increasing when you have more inflation. For example, over the last number of years, when we've been facing this high inflation, not only have we been seeing rent prices grow, which means if you're a cash flow investor in real estate, your rental income has been growing, but also in the stock market. If you're a cash flow investor in the stock market, chances are you've been seeing your dividends grow as well. Now, does this mean that rents and dividends always grow? No. When you go through an economic slowdown, rents can get cut, dividends can get cut, but this is where you have to understand the different ways that you can invest your money. That way you can get paid in more than just one way. Let me start by talking about how you can do this in the stock market. First, by individual stocks, and then second, if you don't invest in individual stocks. Now, I'm not recommending any of the stocks that I'm about to talk about. Bankrate put out an article going over some of their favorite dividend-paying stocks. I'm just going to highlight some of the stocks out of this, so make sure you do your own research. But if you look at the list, number 10 is 3M, number 9 is Walgreens Boot Alliance, number 8 is Philip Morris, and number 7 is AT&T. So let me talk about these. Now, to figure out if a company is paying a dividend or not, or to see what a company's dividend is, you can just go to a site like Yahoo Finance, and what you'll see that at the time when we're recording this video, 3M is paying about a 5.8% dividend, Walgreens Boots Alliance is paying around 5.7%, Philip Morris is paying around 6%, and AT&T is paying around 6% as well. That means based off of these numbers, you'd have to invest right around $700,000 into one of these stocks in order to generate $40,000 a year of cash flow. Now again, the goal with investing in a cash flow company is that now you're investing in a good company, so that when you see a growth in that company, dividends will also grow. And if you see high inflation, the company would also see growth in their dividend potential, so that way you would also generate more cash flow. Is it guaranteed? No, but the idea now is you're working to invest to generate cash flow. But then the next question is, how do you research a company? How do you keep up with a company? How do you know if each one of these are a good investment or not? Because the risk is, well, you could put all your money into AT&T, and now you're hoping that you're going to generate cash flow, but then AT&T could go bankrupt. Now, not only are you not getting any cash flow, but your money goes all the way down to zero, so you lose all of your retirement money. Now what? Well, there are alternatives to investing your money into individual companies, because most people probably shouldn't be in the business of investing their money into individual stocks, because it takes the right psychology, it takes the right financial education, it takes the right patience, and most people aren't interested in learning how to do that, and maybe they don't have the right psychology to actually implement that. So if you don't want to invest in individual companies or do that research, what's the alternative? Because this can be very risky, because now you can see all of your money go down to zero. Well, the alternative would be to invest your money into a fund with the goal of generating cash flow. So let me start by going over a US news article that highlights some high dividend paying ETFs. By the way, if you want to read this US news article or the Bankrate article, I'll also link them for you down in the description. A few of the high dividend paying ETFs that this article mentions are SCHD, VYM, NOBL, and SDIV. What you'll see is at the time when we're recording this video, SCHD is paying about 3.4%, VYM 3%, NOBL 1.9%, and SDIV 13%. Now, before I dive into each one of these, I want you to also understand that you should never make an investment based solely off of what this dividend number is, because this dividend number can be very deceiving. Because, for example, let's say you were thinking about investing in a company that's currently trading at $100 a share that's paying out a $2 dividend. That's a 2% dividend yield. But then let's say something bad happens to the company and the stock price falls to $20 a share, but they're still paying out the $2 dividend. That would mean that the dividend value has gone up to 10%. Now, if you come in and buy because you see, oh my God, that's a 10% dividend, you're going to be very excited. But what you don't see is that maybe this company is on the verge of bankruptcy, which is why the stock price is falling and they haven't cut or stopped their dividend yet. That's why understanding the dividend is just one part of your investment equation, and you should never invest in anything based solely off of what this dividend is. I also have to let you know as a disclaimer that I am personally invested into SCHD and VYM. Before you invest in any fund though, you want to know what your fund is actually investing in, because now when you invest in a fund, you could be investing in hundreds of different companies, and you want to make sure you're investing in a fund that's giving you exposure to the thing that you want. And how do you research that? Well, every single index fund or ETF or mutual fund is going to have a website that explains what it does. So let's go over the different ones, and I'll start by SCHD. At the top of this website, it says that this is the Schwab US Dividend Equity ETF, meaning this invests in US companies that pay out dividends, and the objective is to track as closely as possible the total return of the Dow Jones US Dividend 100 Index, so that tells you what it does. For VYM, you can see that this is the Vanguard High Dividend Yielding ETF, and if you go to the product summary on the right, it says that this provides a convenient way to track the performance of stocks that are forecasted to have above average dividend yields. And then if we highlight the why should you invest in Noble, what it says is that this is the only ETF focusing exclusively on the S&P 500 dividend aristocrats, which are high quality companies that have not only paid dividends but have grown them for all of at least 25 consecutive years, with most doing so for 40 years or more. And then finally we have SDIV, which is the Super Dividend ETF, which says that you want to consider investing here because of the high income potential, because SDIV invests in 100 of the highest dividend paying equities, meaning companies around the world, potentially increasing a portfolio's yield. This is how you would start your analysis to see if any of these funds are investing in the things that you would like, and then you would dig deeper to make sure that the companies that they're actually invested in, again, this is all on the websites for each one of these ETFs. If you want to find them, just go to Google and search any ETF where you can find new ETFs. There's so many ETFs out there. Go out and find some ETFs and just start researching, and that will start to show you what you are actually investing in. Now, if you want more education on how do you actually research your investments, how do you make your first investments, how do you invest your money for cash flow, we have a free ebook in Market Insiders that goes over how to do that. If you haven't read this ebook yet, it's completely free, and I'll put the link to how you can download this ebook down in the description below. Now, just for full transparency, the majority of my investment portfolio is cash flow producing assets, and I invest my money in different places. Now, again, I'm not telling you what to do. I just want to be completely transparent so you understand where I come from when I make these educational videos. My number one biggest investments are into my own business, but I don't consider that your passive investments because I'm actively operating and managing my businesses. My next biggest investment would be my real estate investments. I would put that here because I invest in real estate. That's my largest investment, and this is all cash flow producing assets. When I invest in real estate, I'm working to generate cash flow. Then I have my active stocks, and that would be me investing in individual companies. And then I have my passive stocks. These are me investing in ETFs and funds through a passive system, like I was talking about, where every week for me, I have a system where money is automatically being pulled out of my checkings account and is automatically being invested into my portfolio of ETFs. This happens for me every Wednesday. It happens every week. It doesn't change based off of what's happening in the markets. And the bulk of my passive investments in the stock market are paying me with cash flow. A big chunk of these stocks are also paying me with cash flow. So about 75% of my investment portfolio is cash flow producing assets. So between here and here, about 75% of my total investment portfolio are paying me with cash flow. Then I have some more of my speculative types of investments. Like here, I have my startups. This is a smaller piece of my portfolio where I'm investing in other startups. These don't pay me with cash flow. This is where now I'm investing in these companies, hoping that one day they're going to be worth a whole lot more money, but they're probably going to go to zero, or a big chunk of them will go to zero. That's the reality of investing in startups, that most investments will go to zero. Some of them will hopefully grow and make up for all those losses. Then I have some crypto. I own a little bit of crypto. It's a very small piece of my portfolio. That's kind of the fun. I believe in the value of crypto and Bitcoin for the long term. If it goes to zero, well, it's a tiny piece of my portfolio. If it grows, well, that would be nice. And then I own some physical gold. Again, this also doesn't pay me with cash flow. This is my insurance. This is my doomsday scenario. About 2% of my total investment portfolio is gold. So it's a very small piece of my total portfolio, but it's there kind of like insurance to protect me against worst case scenario types of situations. So now, for me, I like cash flow because now I can keep working to grow the cash flow. I am constantly investing my money, like in my passive stock market investments. I'm investing money every Wednesday, and this is working to buy me more cash flow. Then, when I get paid with my dividends, these dividends are automatically reinvested to also buy me more cash flow producing assets. So it's like a machine that I'm constantly working to buy more of these cash flow producing ETFs, and then these cash flow producing ETFs are buying more of the ETFs every time I get paid. I use a platform called M1 Finance. They are a previous sponsor from Minority Mindset. I like them because they make it very easy to use. They have a lot of free resources to start investing. If you want to learn more about them, you can use my affiliate link, meaning if you use my link, we will get compensated. You can do your research, find a platform that you like, but if you want to use my affiliate link, I got that link for you down in the description below. The second way that you can start generating cash flow is by investing your money in real estate. Now, when I invest my money in real estate, I invest my money not to flip my property for a big profit. I invest my money for one reason, which is cash flow, because I can, one, predict how much cash flow I'm going to get way better than I can predict how much a property is going to be worth in 2 years. And second, cash flow is much more stable. I'm not worried about future speculation because if property prices fall, oh well. I'm investing for cash flow. So the way that I invest my money, I look for a 7% cash on cash return on my money, meaning for every dollar that I invest, I'm looking for 7 cents of profit from cash flow from the property. This does not include appreciation. If appreciation happens, that's icing on the cake. That is the cash flow that I'm getting. So if I was to invest $100,000, let's just say, into this property, and I bought this property all cash, I would want $7,000 of profit being deposited into my bank account after paying all of my expenses. And the expenses include your property taxes, your insurance fees, your maintenance fees, your management fees, because I don't manage my real estate myself. I have a property manager that handles all the day-to-day work and covers any of the vacancy costs. So now, after you cover all the expenses, That's the type of return that I'm looking for. Now, if you're a real estate investor, you might be saying, wait, how are you getting a 7% cash on cash return on your money? Because this depends on where you are investing your money. There's certain areas around the country that are going to see 1 to 3% cash on cash returns. You have other areas in the country that might be 3 to 5% returns, and you have other parts of the country that might be 7 to 10% returns, and then you have other areas that will be 10 to 15% returns. Now, just like with dividends, you don't just want to look at this return by itself, because this doesn't tell you the full picture. Because in real estate, the higher the return can also be the higher the risk. Because now if you're investing in an area that's giving a 15% return on your money, chances are you might have more risk. You might have a tougher time finding a good tenant. You might have more evictions. You might have more crime in the area. You might be investing in an area that's not seeing much business growth. And so you have to understand now that more return also comes with more risk, and different parts of the country are going to have completely different types of returns. And this is where now your job as an investor to find the sweet spot for you. What types of returns are you looking for? This for me is where I'm looking right now. Now, could this ever change in the future? Sure. But for me, these are the types of returns and the types of deals that I've been able to find my sweet spot, because I look for distressed properties. And these could be physically distressed or financially distressed. A physically distressed property is what most people will call a beat up property. You walk into a property, it smells like crap, the carpet is disgusting, there's holes in the walls, it just doesn't look good. I like these types of deals because now I can come in and find a deal that nobody else wants to buy. So then I get to come in and buy it at a discount, and I have a good team in place where we can come in and rehab and turn around the property at an affordable price. And now I get a fully remodeled, very nice looking property at a below market price. That way now I can already increase the returns that I'm getting. The alternative is a financially distressed property. This would be something like an apartment complex where now it was mismanaged. The previous owners had too much debt, or they didn't know how to manage the property, and now this property is essentially vacant, or tenants are not paying, or something bad is going on in this property in a good area where I believe businesses are growing. And now I would come in, buy this property, and have to put in the work, the time, the money, and the effort to turn this property around. And a lot of people don't like these types of deals because, well, it requires way more work and there's more risk associated with it. But if I know the area, I believe that's where businesses are going, I have a good team in place, which took a long time to build. Because I know a lot of people talk about real estate being this passive investment. You just put your money into real estate and you hand over the keys to your property manager and you're done. Well, in reality, it doesn't really work like that, because for me, when I got started in real estate, I had no experience. I had no one to guide me. I had no one to teach me. I just jumped right in because I wanted to invest in real estate, and I made every mistake possible. And it was essentially like a full-time job, because I didn't know what a good contractor was. I don't know where to find contractors. I don't know who a good attorney was. I don't know where to find good attorneys. And so I dealt with bad contractors, bad attorneys, bad accountants. And I had to go through the process, which was, one, very expensive, but two, very time-consuming. But over the years, over more than a decade now, I've been able to build a good team, figure it out, and put in the work, which makes it much more streamlined for me. So if you want to invest in real estate, understand that it can provide great returns, but know you're going to have to go through this hurdle. And this hurdle is, one, a time hurdle where you're going to have to put in the work, not only to learn by reading books, but then do the actual work by investing in real estate and making the mistakes. And understand that every real estate investor has a bad deal. I made a video of my worst real estate deal ever on YouTube. I covered it. That was, to date, the only deal that I've ever lost money on, but it was extremely painful, not just financially, but mentally, because of how draining it was. But these are the things that you learn how to deal with issues by going through screw-ups, by going through mistakes, by screwing up, by failing, and understanding if you're willing to go through that, then real estate investing can be a great tool for you to build wealth and grow your wealth. But it doesn't happen by itself. It takes time, it takes effort, and it's going to take a learning curve through you. And if you're willing to do it, great. But just don't believe all the it's completely passive, you don't have to put in any work stuff. It's going to be its own process, and it can be a great return, but you have to be willing to go through that process. Like, what happens if you're getting close to your retirement age and then a recession hits? Then what? We saw this happen before the 2008 crash. We saw this again in the 2020 crash, where the market crashed and people were selling out of their retirement accounts at huge losses. But what if you could get paid while you wait for your investments to grow in value? That's exactly what you get